Welcome to the Deep Dive. Today, we are opening up a really fascinating document, the 2017 Shareholder Letter from Morgan Stanley. This one's from Chairman and CEO James P. Gorman. And our mission for you, the curious learner, is pretty straightforward. We want to pull back the curtain on the corporate language. We're looking for, well, three things mainly. The core strategy, those key 2016 performance targets, and maybe most importantly, the big macroeconomic bets the firm was making for 2017.
Right, and the context here is just so important. This letter, remember, it's April 2017. It really is a snapshot in time. You've got this major financial institution still adapting its business model post-crisis, navigating all the regulation, and coming out of 2016, the big themes are definitely, internal discipline, diversification, really focusing on expenses.
Okay, so let's start with that core strategy. Gorman used this great metaphor,
Yep.
the engine and the ballast. Can you break that down for us? Why that duality?
Yeah, it's a classic way to think about balancing risk. The two parts are meant to perform differently, depending on the market. The engine, that's the high-powered stuff. Investment banking, sales and trading, big returns, potentially, but also more volatile.
Okay, the powerhouse.
Exactly. And then you have the ballast. That's your anchor, their big wealth management business, plus investment management. More stable, less cyclical, designed to provide that steadiness.
And the letter makes a point that by 2016, this wasn't just theory. It was working. Net revenues were split pretty much evenly between the engine and ballast.
Absolutely. The balance was real operationally. And underpinning that structure, they talked a lot about culture and leadership, core values like putting clients first.
Right.
But what really struck me was the focus on the leadership pipeline almost as a strategic asset itself.
So planning for the future, not just managing the present.
Precisely. Look at the Colm Kelleher move. Elevating him to president, overseeing both the engine and the ballast institutional securities and wealth management. That's a big structural signal.
Ties it all together at the top.
Right. And it lets Gorman focus more on the longer-term strategy. Plus, they specifically name-check others coming up, like Ted Pick in sales and trading, Shelley O'Connor, Andy Saperstein in wealth management. It showed they were serious about developing that next generation across the board.
Okay, that structure makes sense, and it seems linked directly to the financials, particularly those aggressive targets they set. They grew pre-tax profit in 2016 by almost $1 billion, even though revenues were nearly flat. That points to cost control, right?
It definitely does. But, that 2016 performance was really just setting the stage. The letter quickly pivots to ambition. And the big one, the main target for 2017, was hitting a return on equity ROE between 9% and 11%.
Okay, let's pause there. ROE, return on equity. It's key, but maybe a bit jargony for some listeners.
Yeah.
Why was that the metric? And why was 9 to 11% such a big deal for a bank like Morgan Stanley in 2017?
Sure. So ROE basically tells you how much profit the bank makes for every dollar shareholders have invested in it. After the 2008 crisis, regulators made banks hold way more capital, which naturally makes it harder to generate high returns on that equity.
Right, the safety buffer.
Exactly. So for a huge firm like Morgan Stanley, just hitting that 9% baseline was a signal. It said, okay, our transformed business model works, we're using capital efficiently, getting up towards 11% in that regulatory environment. That's really strong performance.
And the letter notes this ROE target excluded something called debt valuation adjustments using a non-GAAP measure. Why strip that out?
Mainly for clarity. Debt valuation adjustments, or DVA, relate to changes in the market value of the bank's own debt. It can swing around quite a bit based on market sentiment, not necessarily the core business performance.
So it can muddy the waters.
It really can. By excluding it, they're essentially telling investors, judge us on our core banking and advisory operations, the actual profitability we generate day to day. It shows focus.
Okay, so hitting that demanding ROE target required more than just good market conditions. They needed a serious internal push. Which brings us to Project Streamline. $1 billion in cost reductions targeted for 2017. That sounds
Huge. It is huge. Extremely aggressive. I mean, think about it. $1 billion in annual savings. That has to touch pretty much every part of the firm globally.
And how do you even find that kind of saving?
Well, the letter doesn't detail every cut, but typically savings that big come from, a few main areas. Rationalizing office space, using technology to make back office processes way more efficient, and potentially, yes, some headcount reduction or cutting back on non-essential spending.
But I wonder, though, if you're pushing for this firm-wide, expense-focused culture, is there a risk you cut too deep? Especially in the engine side, the institutional business, where you need top talent, who are often highly paid.
That's absolutely the tightrope they had to walk. The letter implies the cuts were meant to be broad, focused on efficiency gains, not just, firing star bankers. The goal was a specific number, a 74% expense efficiency ratio.
Meaning they wanted only 74 cents out of every dollar of revenue to go towards costs. That's running a very tight ship. It basically requires that efficiency, often tech-driven, to make sure you're not harming the parts that actually bring in the money.
So cut costs hard on one side and reward shareholders on the other.
Exactly.
Yeah.
Though the other side of the coin, capital return. They'd already boosted it by 50% in 2016, returning $4.8 billion through dividends and buybacks. And they made it clear they wanted to return even more, assuming the regulators approved.
So the formula was grow profits operationally, slash costs aggressively, and give back capital.
That's the mathematical path they laid out to hit that high-end 11% ROE target.
Okay, let's pivot then to the divisions, starting with the ballast wealth management, because this is where, as you said, the big external bet really comes into focus. They hit 22% profit margin in 2016, but the target for 2017 was higher.
Oh yeah, much higher. They were aiming for 23% to 25% profit margin by 2017. And this is where those macro bets we mentioned earlier become really explicit in the letter.
Well, making that jump from 22% potentially up to 25% was heavily dependent on something totally outside their control.
Rising interest rates.
Bingo. The Fed. The letter specifically calls out the expectation of Federal Reserve rate hikes in 2017 and 2018, plus, generally more positive investor sentiment.
Why are rate hikes so crucial for wealth management margins?
Because when rates go up, the firm can earn a lot more money on the cash that clients keep in their accounts, those sweep deposits. It's a huge lever for profitability in that business. Getting to 25%, they really needed the Fed to deliver.
But they weren't just sitting back waiting, were they? Did they have internal ways to capitalize if the Fed did act?
Oh, absolutely. They were ready. They'd spent years building out their U.S. bank infrastructure. The specific goal was attracting more client deposits and being able to do more high-quality lending against those deposits.
And that paid off.
Hugely. The letter states it increased the firm's overall interest income by 20% in 2016 alone. So yes, they had the plumbing in place. They built the capacity to capture that upside from higher rates the minute it happened.
Okay, so that's the ballast bet. What about the engine, the institutional side? The letter sounds pretty confident there too.
Yeah, it paints a picture of real market leadership. The Institutional Securities Group, ISG, was presented as world-class. Investment banking, for instance, consistently ranked number 2 globally in M&A advisory and number 2 in IPO underwriting. That's serious clout.
And they expected things to pick up in 2017.
They were optimistic, yeah. 2016 had been a bit slow for equity underwriting across the market, so they expected a normalization, basically a return to more typical deal flow, which would let them leverage those high rankings.
And what about sales and trading? That's often the really volatile piece of the engine.
Well, their equity sales and trading was, frankly, dominant. Number 1 globally in revenues for the 3rd straight year. That kind of consistency is pretty remarkable in trading. But maybe the more interesting internal story they highlighted was fixed income sales and trading. FICC, as they call it.
Why was fixed income so interesting?
Because they'd gone through a major restructuring back in 2015, cut resources quite significantly. For 2016, they set themselves a benchmark. Could they average at least $1 billion in net revenue per quarter with those reduced resources?
And could they?
They did. They exceeded the goal. It was kind of a proof point for the whole internal discipline message, showing that Project Streamline wasn't just talk. It could deliver results even in a complex area like FICC. And it positioned them to capture upside if the macro environment got more active for trading.
Right. And just quickly, the third piece of the puzzle, the other part of the ballast investment management.
That was presented as stable, but also undergoing some internal tidying up. They had over $400 billion in assets under management, which generates nice, steady management fees. The focus there seemed less on explosive growth and more on organizational realignment, rationalizing costs, unifying the different parts of the business for more steady, long-term contribution.
Okay, so we've got the internal machinery, the divisional bets. Let's zoom out again to the big picture. The macro environment they saw in early 2017. What was Gorman's take?
Generally optimistic, but very U.S.-centric in that optimism. The letter describes the immediate U.S. outlook as generally more positive, And the drivers cited were expectations of faster economic growth and, crucially, those rising interest rates, both linked to potential policy changes from the new Trump administration.
So they were banking on pro-growth policies.
They were definitely factoring in the prospect of regulatory relief and fiscal stimulus, yes. That positive U.S. view was a core assumption.
But they weren't ignoring the rest of the world.
No, not entirely. They mentioned continued investment in Asia and a belief that most European economies had kind of bottomed out. But they were also very clear. Political risks, economic risks, those were still significant globally. Things could easily disrupt the forecast.
So U.S. optimism tempered by global
And
caution.
I think that's fair. And they also stressed their confidence in being able to adapt to whatever came next on the regulatory front. Preparedness seemed key.
Which brings us neatly to technology. It wasn't just mentioned as a cost center to be streamlined. It sounded like a core strategic investment.
Yes, this is maybe the most forward-looking part of the whole letter. Gorman states very clearly that the firm's biggest strategic challenges and its opportunities will almost all derive from technological change. That's a powerful statement of conviction.
And where were they directing those tech investments?
Seems like three main buckets. First, cyber defense. Just table stakes, really. Strengthening defenses against hacking and data theft. Mandatory investment.
Makes sense.
Second, using tech for operational efficiency. Improving processes, automating things, which directly supports Project Streamline and that 74% efficiency ratio goal.
And the third?
The client-facing side. Meeting expectations with really top-notch digital platforms. So for the ballast, that meant things like a better online experience for wealth management clients. For the engine, it meant sophisticated electronic trading systems, especially in fixed income.
So tech was woven through everything.
Absolutely. The message was clear. Long-term winners will be those able to adapt and use technology to their competitive benefit. Technology wasn't just a tool, it was seen as fundamental to their competitive edge in this new, evolving landscape.
Okay, so let's try and pull this all together for you, the listener.
Yeah.
Morgan Stanley's 2017 game plan, as laid out in this letter, was really this intricate balancing act. You had intense internal focus, Project Streamline, cutting costs, the leadership structure, the big tech investment.
Things they could control.
Right? Things they could control. But then their most ambitious targets, especially that leap in wealth management profit margin, were really quite dependent on external factors playing out just right. Specifically, the Fed delivering those interest rate hikes.
Yeah, the final takeaway for you is really seeing how all these pieces connect. They use that internal discipline, cost cuts, restructuring FICC successfully to free up resources. Then they plowed those resources into technology and strengthening their core businesses. But the ultimate payoff for that strategy, hitting that high-end ROE target, hitting 25% margins in wealth management, was significantly leveraged to things outside their building, primarily the Federal Reserve's actions. And maybe this leaves us with a provocative thought to consider. The letter states so clearly that long-term winners use technology for competitive benefit, implying internal strength drives success. So how does that square with the strategy where hitting your key profitability goal relies so heavily on an external factor like interest rate moves? What happens to that ambitious plan, that 25% margin target, if the macro winds, specifically the Fed, don't blow in the direction they were so clearly banking on?